Hi there, this is Sean O'Toole for Exercise Your Options, and this week we're going to talk a little bit about a new product being offered by the CME Group in Chicago, specifically Bitcoin futures. This is something that people have been talking about for quite a long time, and it's relevant to us in the options world because once there is a viable futures contract, there's plenty of room for options to trade. So let's get right into it and look at what the details are of this contract. First off, the contract is financially settled. It will not be deliverable in Bitcoin. It'll be a cash settled product, which is probably a really good idea because it allows a lot of participation by institutions that don't necessarily want to buy and hold Bitcoin. The exchange behind it, CME Group, is the largest exchange in the world, solid financial base behind them. This is all a good thing for bringing in new participants into the Bitcoin market. The aggregator of the index is Crypto Facilities Limited. I don't know anything about this company other than I believe they were put together specifically to track indexes for use with futures contracts, and their history looks to go back about a year. Two assets will effectively be making up this index. There will be a real-time index known as the Bitcoin Real-Time Index, or the BRTI, and then for settlement purposes, there's a Bitcoin Reference Rate, or BRR, and the BRR was done differently than the BRTI, specifically to conform with the IOSC principle for financial benchmarks. The IOSC, or International Organization of Securities Commissions, put together a paper a number of years ago that guides exchanges in how to put together indexes in such a way to deter any sort of manipulation and that sort of thing. And we'll get into the calculation of the BRR, and you'll see that it would be pretty darn tough to manipulate this index, which I think is good for everyone involved in the marketplace. The index and both the settlement and the real-time are calculated every day of the year. The index, the real-time index, trades 365 days a year, year-round, 24 hours a day, which makes perfect sense. Bitcoin trades same terms, and I can't imagine a futures contract succeeding if it doesn't trade 24 hours a day, as one would expect that there will be participants in the Bitcoin market that will want to use the futures market specifically to hedge their risks in Bitcoin, and if the market is closed, it wouldn't make sense. So I guess without a terms and conditions sheet in front of me that's not yet been released, I guess I can say pretty unequivocally that this will trade 24 hours a day, or perhaps a minute or two off at settlement time. So let's jump right into the Bitcoin reference rate and how that is calculated. It's a little arcane, but it's worth understanding at least the general overview so that you know what the daily settlement looks like. So the BRR is an aggregation of trades from various Bitcoin exchanges in a 60-minute window up to and including 1600 London time on a given calculation day. What that means is it's not just the last trade of the day that forms a settle. It's potentially all the trades occurring in the last 60 minutes will be averaged, and we'll go into how that average is calculated in just a moment. The constituent exchanges that will participate in this process will initially be 4 exchanges, and that number could grow at some point in time, or it could decrease, depending upon as exchanges come and go. I'm not familiar with these 4 organizations. I will say I understand the mechanics and the algorithms behind Bitcoin very well. I do not, however, know much about the Bitcoin marketplace. I'm not an active Bitcoin trader, though I'm an active trader in general and have been in the markets for many years, but Bitcoin is not something I participated in. So the 4 exchanges are called Bitstamp, GDAX, IT or ItBit, and Kraken. I looked at the websites of all of them, and they all seem to have assets and lots of trading going on, so that's a good thing. What they'll be doing is taking all of the relevant transactions, in other words, the transactions that occur during that 60-minute window, adding them into a joint list. They'll be recording both price and size of the trade, and this is for a volume-weighted average. They'll be partitioned into 12 5-minute intervals. Volume-weighted medians will be calculated for each interval specific to each exchange. The BRR is an average of the 12 volume-weighted median results. Of course, market data will be collected real-time via an API, and APIs can fail. So they've got pieces in place to deal with such a failure. In the case of an API failure, the relevant transactions from that exchange would be disregarded during the time of failure. If no relevant transactions occur or none are transmitted, the constituent exchange that has no relative transactions would be disregarded in that day's calculation. So if there's an exchange that is much smaller that's added at some point in time and it has only the occasional trade, it simply wouldn't make it into the calculation. If a TWAP partition is empty, TWAP is time-weighted average price, that period will be disregarded and the denominator will be decremented. What that means is, in the event that at some odd time of the day there is no trade during a 5-minute window, that time frame will be just simply disregarded, and rather than dividing the overall average by 12, it'll be divided by 11 at that point. Or if there are two such windows that have nothing in them, it would be denominated by 10. If no relevant transactions are recorded on a constituent exchange, or if all are flagged as erroneous or potential erroneous, the previous day's settlement price stands. What that means is if there are no trades during that last 1 hour, or if there are technical difficulties or a number of potential problems, anything that smacks of any kind of manipulation, it could potentially put it into a position where there are no calculations, no transactions from which to make a calculation, so they would just issue the previous day's settlement. This isn't going to matter to an individual investor. To a corporation, or I should say a fund, it may matter. Potentially erroneous data is defined as when a constituent exchange's volume-weighted median for a particular partition deviates more than 25% from the median of volume-weighted medians for all reporting constituent exchanges for that partition. That constituent exchange's relevant transactions shall be flagged as potentially erroneous and disregarded for the purpose of calculating that day's settlement. What does that mean? That means if in any particular 5-minute partition window, if trades were to come in that were more than 25% away from the market. So in simple numbers, Bitcoin is trading at 4,000, and a trade comes in that's $1,125 higher or lower, it's going to flag a problem, and that particular trade is going to be pulled, and that whole 5-minute window for that participant exchange or constituent exchange will be erased and not considered. Again, trying to keep volatility low and potential manipulation out of the equation. Erroneous data is any data that doesn't conform to the data standards set forth in the contract, i.e., non-numeric or non-positive trade price, or any format that cannot be parsed. And what that would mean, a non-parsable number would be if the API started throwing numbers without decimal places, or too many zeros, or something like that. Something that doesn't parse out correctly, rather than someone trying to fix it on the fly, they just simply throw that data out. So that's the basics of how the BRR works, and as I said, it doesn't matter much for individual investors. Individual investors are going to be pretty much, if you're trading close to your margin limits and the trade goes against you, you're going to be blown out instantly if the trade goes against you to a point where you don't have enough margin on hand. So other than vanity points and being able to see, hey, I was up today or down today, it simply doesn't matter for an individual investor. For an institutional investor, it may matter. Number one, they're marked to market they have to be marked to market on a daily basis. And the other thing is we can pretty well be assured that once we have exchange traded derivatives we will see over-the-counter derivatives, and they require a solid close, or potentially their derivatives are marked against. If they're marked against an incorrect market, it can cost everybody a lot of money. So we try not to do that. So let's move on to the Bitcoin Real-Time Index, or the BRTI. This is the index that is shown at the CME's site right now, cmegroup.com. This is updated in real time all the time right now, 24 hours a day. It's worth going and having a look. It's a real-time index of Bitcoin versus dollars, comprised of bids and offers on the order books of all constituent exchanges. This differs from the settlement. Settlement is actual trades. The real-time index is bids and offers, and there's a reason for this. Bids and offers tell us where you can trade. It doesn't tell you where we traded. It tells you where the market is right now. Where can you really actually get a trade-off? So it's pretty realistic number. Constituent exchanges order books are consolidated into a single order book with order size noted. In other words, this is going to be a volume-weighted index. Order sizes larger than 100 orders to buy or sell larger than 100 Bitcoin are capped at 100 Bitcoin for calculation purposes. This is to prevent manipulation by putting in large orders. It's as simple as that. When they do the calculation of the index on the fly, keep in mind this is all calculating real time, there are 4 curves to be calculated. The cumulative bid price volume curve, or I'm calling it a BPVC just for short for my own purposes, the cumulative ask price volume curve, the cumulative mid-priced volume curve, and the cumulative mid-spread volume curve. We'll go into each individually. Actually, bid and offer are the same, just for bids and sells, so we'll not spend much time on the second. The bid price volume curve maps Bitcoin transaction volume to the Bitcoin dollar price a seller is required to accept in order to sell this volume to the consolidated order book. So this is looking at how big the orders are at the front of the book, at the closest to the market, and determining it's determining depth of transaction, so that effectively we're trying to get prices that don't reflect what a one lot can get traded at. We want to see if there's potential for trade at up to say 50 or 100 lots. We want to see what the size, what the depth is. We want to know what the price is that 100 lots can get traded in, for instance. Ask is just the opposite of that, maps the Bitcoin transaction volume to the Bitcoin USD price a buyer is required to pay in order to buy this volume from the consolidated order book. The mid-price volume curve, or as I'm calling it, the MPVC, it represents the average of the bid and offer. The mid-spread volume curve represents the percentage deviation of the offer side, or ask, from the mid price, which means if you think about it, and if you go and look at the index online, it's always slightly, the stated price is always slightly above what the current Bitcoin market is if you follow it against exchange traded Bitcoin pricing. Now they're calculating what's called a utilized depth for the actual BT, the BRTI index. The utilized depth, and this gets pretty technical, and I've got a link here to read further about if you want to go into it. I'm not going to even talk about this other than to read it, because I don't honestly fully understand it at this point in time. I haven't gone into it deeply enough. But utilized depth is the maximum cumulative volume for which the MSVC, or mid-spread volume curve, does not exceed 0.5%, and the minimum utilized depth is set to 1. The MPVC, or the mid-price volume curve, is then weighted by the normalized probability density of the exponential distribution up to the utilized depth. The BRTI is the sum of the weighted mid-price volume curve. Again, it's worth going to the CME Group side and looking at this particular file. I will put a link to this in the notes below, so that you can link direct. So that's it for how the BRTI works. Again, it's more complicated. Generally, the idea here is to throw away the oddball transactions that might jerk the index back and forth and keep a relatively consistent number. And if we're going to get institutional participation in this, it needs to be a consistent number. It needs to be a realistic number. If Bitcoin is flying around, it needs to represent a market that's flying around. But when there's one trade at $7,000 and the next trades at 6,500, you might want to ease that volatility down in order for it to be a good hedge. So a few thoughts of my own on this. Number one, this should reduce the intraday volatility of the physical Bitcoin market. Every time that we've launched a futures contract on a volatile underlying market, it has reduced the volatility, not increased. It's important to know. Oftentimes the media will say just the opposite. They really don't know. Allows for short selling, thereby creating an environment conducive to options trading. As an options market maker, I am not going to make a market in any contract that I don't have a liquid market in and a shortable market in. I simply cannot make markets in options without the ability to buy and sell the underlying. And in this case, it's a futures contract. I would not jump in and make markets in a market that I could not get both two-sided trade in the underlying, or I would be slaughtered as a market maker. Last point, if successful and if other crypto assets are ultimately listed as futures trading, there's potential for an actively managed crypto assets fund out there. At this point in time, there's nobody who would want to really get into that. There's obviously interest in creating ETF markets right now, but ETF markets, they just need to get the stuff bought relative to the size of the fund and then hold. In the case of an actively managed fund that would be potentially many crypto assets, you need the ability to jump in and use the futures market when you get large buy orders in the fund. You need to be able to buy a futures contract that represents, or a series of futures contracts that represent the underlyings, and then come in and backfill, get your assets bought, and then sell off your futures contracts. Same is true of the sell side. You would want to be able to jump in and sell futures, and then turn around and sell the underlying asset when the market is conducive to the sale. But by using the futures contracts, you'd have the ability to get those transactions off instantly, which would allow for an actively managed crypto fund. So a lot of interesting things happening. Obviously, this is just the futures now, but I do think that once the futures show good two-sided trade, we'll see options listed very quickly thereafter, at which point in time I'll be back on talking about opportunities on the options side here. So for now, thanks very much. Again, this is Sean O'Toole with Exercise Your Options. Thanks for watching. Take care.